Hello, this is CA Reshma Jain here. Today we'll take the topic of salaries applicable for May 2025 CA Intermediate. Okay, so what is salary? For it to be a salary, there should be an employer-employee relationship. So there should be an employer and there should be employee. There should have been services rendered by the employee and employer pays for the services rendered. Such a case, it is called as salary. Full-time or part-time employment. It can be either full-time or part-time employment as well. Foregoing of salary. See, if I'm earning some salary and I'm saying that I do not want that salary to the employer and I'm asking him to donate it to a certain charitable institution, will the salary be taxable? Yes, salary will be taxable because that will be considered as application of income. That will be considered as only my application of income, and such donation I can claim under ATG if I have opted for old regime. If I have opted for default tax regime, then I cannot get such deduction. Surrender of salary. There may be case where I surrender my salary to the central government. In such case, that then the salary would be exempt. Salary paid tax free. Suppose the salary is paid tax free. Suppose employer has paid tax on my salary, then will that be included in my salary? Yes, but such tax will be such, like for example, if the employer has paid tax on my salary, so what will my salary include? My salary will include salary as well as the tax portion which the employer has paid. It is also benefit for me, so that portion is also included in my salary, but that such tax portion will be excluded if it is on non-monetary perquisites on behalf of employee, would be exempt in the hands of employer, in the hands of employee. See, when my employer is paying tax on the salary of my then what will my salary include? Salary portion plus the tax portion which the employer has paid. So it will be exempt in my hands if it is paid, if the tax is paid on such non-monetary perquisites. Okay. Basis of charge of salary. Salary is chargeable to tax either due basis or receipt basis, whichever is earlier. So now if advance is paid, then it will be charged to tax in the year it is received. If there are arrears of salary, it will be charged when the due, on the due basis. So once it is charged, again if we have received it, it will not be taxed again. Okay. Advance salary. See, we have just now discussed advance salary will be taxed on the basis of receipt or whichever is due basis, whichever is earlier. Now suppose we have received advance salary in the year previous year 23-24, and we have actually it is due only in the year 24-25. We have charged to tax in the year 23-24, and the tax rates on these 2 years are different. What will happen? We will get the relief under section 89. There is a calculation which will be discussed later. Now what is difference between advance salary and advance against salary? Advance salary, salary received in advance, and advance against salary is employee getting a loan against its salary is advanced against salary. Arrears of salary. The arrears, now for example, see, arrears of salary should be charged. Salary is generally charged in due or receipt basis, whichever is earlier. In that case, arrears of salary should be charged on due basis. But there will be cases where it cannot be charged on the basis of due. Suppose retrospective effect of revision of salaries is there. In such a case, what will happen? It will be charged in the receipt basis. And what if there is a difference in tax? Section 89 relief will be given. Okay, so salary perquisite and profit and lieu of salary. Okay, salary can be what? Monetary, non-monetary. What a salary includes? Salary, pension, gratuity, perquisites, advance salary, arrears of salary, leave encashment, provident fund to extent it is taxable, pension to extent it is taxable, and any contribution by CG in under section 80 CCH. What is wages? See, there can be salary, wages. The words can be used interchangeably. Any sort of wages will be 100% taxable. Allowances. Okay, now let's come to allowance. What is allowances? Allowances will be generally taxable. However, there are exemptions in under certain under the both tax regimes or under either of the tax regimes. So let's check that. Okay, first take special allowances. Special allowances comes under two category. One is 1014.1 and 1014.2. 1014.1 is allowances to meet performance of duties in employment, and 1014.2 is to meet personal expenses where he resides to perform his duty or to compensate the increased cost of living. Now in 1014.1, in old regime, what is taxable is what is exempt is actual amount received or actual announcement, whichever is lower will be exempt. So he has received 500 per month, but he has spent only 400 per month. So 400 per month will be exempt. What are all such allowance? Helper allowance, research allowance, uniform allowance, traveling allowance, daily allowance, and conveyance allowance. So all these are exempt to the extent of expenditure incurred if they are less than the actual amount received. Okay. Now under new tax regime, what all is exempt? Only these three. Traveling allowance, daily allowance, and conveyance allowance is exempt. Now under section 1014.2, to meet the personal expenses where he resides to perform his duty or compensate increased cost of living, a specified amount is exempt, whether spent or not. So under old regime, we have to refer a table. What is the table? What will be the specified limit? And under the new regime, only one allowance is exempt, that is transport allowance given to deaf, dumb, blind, or handicapped, which is 3,200 per month. This is also given in the old regime, but old regime, apart from this transport allowance, there is one table which gives exemptions to certain amount. Let's see the table. Okay. Now, special compensatory hill area allowance or high altitude allowance or snowbound area allowance or avalanche allowance, 800 or 300 per month depending on specified locations, 7,000 per month in case of area of Jammu and Kashmir. Any special compensatory allowance in nature of border area, remote locality, difficult area, disturbed area allowance, 1,300, 1,100 or 1,050, 70, 300 per month depending on the specified locations. Special compensatory schedule area allowance, 200 per month. Now this is only exempt for the old regime. All these will be only applicable for the old regime. Suppose there is a employee working in a transport company and he is not receiving any daily allowance, then 70% of such allowance will be exempt, provided up to maximum of 10,000 per month. Children education allowance, 100 per month per child, up to a maximum of 2 children. Suppose first your children is born, and again when the next children is born, twins have been born, then also for the 3 child allowance will be given. Suppose in first case twins are born and then the next time one child is born, in such case exemption will not be allowed. Any allowance expenditure meet the hostel expenditure will be 300 per month per child up to a maximum of 2 children. Compensatory field area allowance 2,600 per month. Compensatory modified field area allowance 1,000 per month. Counter insurgency allowance granted to the members of armed forces 3,900 per month. Underground allowance 800 per month. High altitude allowance granted to the member of the armed forces operating in high altitude areas, if it is 9,000 to 15,000 feet, 1,060 per month. Above 50,000 feet, 1,600 per month. Special compensatory highly active field area allowance 4,200 per month. Island duty allowance for the armed forces in Andaman and Nicobar 3,250 per month. Suppose we are claiming disturbed area allowances here. Suppose we are claiming disturbed area allowance in the serial number 2. Then we cannot claim this 7, 8 and 9. Okay. Apart from this, what is also exempt under old regime is transport allowance to blind, deaf, dumb, handicapped, blind up to 3,200 per month. Okay. Next is HRA. HRA is only exempt for old tax regime and not for new tax regime. It is fully taxable in new tax regime. So let's see HRA. House rent allowance. In old tax regime, the amount of what amount will be exempt? The actual HRA received, rent paid minus 10% of salary for the relevant period, 50% of salary for the relevant period, whichever is lower. For other cities, it is 40% of the salary of the relevant period. Now, what is the relevant period? Means during period which said accommodation was occupied by the SSC. If the SSC has occupied the house only for 7 months, then 7 months will be the relevant period. So in such a case, the lower of these three will be exempt. Now, what is salary for this? Salary will be basic pay plus DA plus commission forming given as a fixed percentage of the turnover. Okay, let's see this sum. Rajkumar is following receipts from his employer. Basic pay 40,000 per month, DA 6,000 per month. DA will come only if it forms in the terms of employment. If provided in terms of employment, there can be 2 DA provided in terms and not in terms. So only if it in terms, then it will be added to salary for computing HRA. Commission is not given as a fixed percentage of turnover. Motor car for personal use, house rent allowances. Find out the HRA exempt in the hands of Mr. Rajkumar, assuming that he has paid rent of 16,000 per month at Kanpur. DA forms the part of salary for retirement benefits. So it is in terms. Exercises the option of shifting out of default tax regime that he is exercising. He is not exercising shifting out of new tax regime, that is he is exercising old tax regime. Now how you should give the answer is, first you should give the main answer. HRA received less exempt under section 1013A taxable HRA. Just keep these blank. Keep your as working note 1, 2, show your as 1 minus 2. What happens is, now give here the note. Note number 1, actual HRA received will be, see, even if there is simplest of simplest calculation, show it in your answer paper 15,000 into 12, because just like that doing in the calculator 50,000 into 12 will not be part of your answer, so you will not carry marks. Even though your calculation is wrong, you will get some marks for showing the calculation. So show even the simplest calculation. So actual amount received is 1,80,000. So now rent paid minus 10% of salary will be 10% of basic and DA, and will be 1,36,800. 40% of salary, because he is situated in Kanpur, 2,20,800. What is lower is 1,36,800. You have to subtract. Taxable HRA is 43,200. Okay, now allowances which are fully exempt only under optional tax regime, that is old tax regime. Advances to Supreme Court, High Court judges. Any allowance paid to judge of a Supreme Court or High Court will be exempt under old tax regime. Allowances received from UNO. Salary or allowance paid by UNO to its employees is not taxable by virtue of section 2 of that act. So, and sumptuary allowance given to High Court judges will not be taxable. So in these three cases, it is exempt under old tax regime. And what is exempt under both the tax regime? Allowances paid outside India. Any allowances or perquisite paid outside India by government to a citizen of India for services rendering outside India are exempt from tax. We are giving, government is giving the allowances to citizen of India for rendering of services outside India, and such allowances is exempt in both the tax regimes. Okay, so let's start with the next topic, annuity or pension. What is annuity? Annuity will be treated as salary. It is monthly payments. Okay, a person invests some money, then monthly or yearly payments, he will get equal annual sums. Sorry, it is annual sums. Such annual sums are annuities in the hands of the investor. Now, what happens in the case of annuity? If it is received from present employer, tax as salary; from past employer, tax as profit in lieu of salary; person other than employer, tax as IFOS. Present employer salary, past employer profit in lieu of salary, other than employer income from other sources. Now, what is pension? Pension can be of two types: uncommuted pension or commuted pension. Uncommuted pension means you are receiving pension, monthly pensions. You are not taking lump sum amount, but you are receiving monthly pension. Such pension is fully taxable. What is commuted pension? You are receiving commuting your pension and receiving lump sum amount. In such case, what will be the taxability? In uncommuted pension, what will be taxability? In uncommuted pensions, whether received by government employee or other employee, it is fully taxable because we are receiving it monthly. For commuted pension, if it is government employee, it is fully exempt. For other employees, we have to see whether they are receiving gratuity or not. Whether they are receiving gratuity. If they are receiving gratuity also, the exemption amount will be only 1/3 of the total total pension. If they are not receiving gratuity, then it will be half of the total commuted pension. So now, what is this commuted pension? Divide by commutation percentage into 100%. We'll check this with the help of the example. Now, Mr. Shagar, who retired on 1st October 2024, is receiving 5,000 per month as pension. On 1st February, what is in commuted 60% of his pension and received 3 lakh as commuted pension. You are required to compute his taxable pension, assuming he is government employee. Now, if he is government employee, what will be his uncommuted pension? Will be taxable, fully taxable. His commuted pension will be exempt. So now we have to calculate uncommuted pension. Uncommuted pension is 5,000 from October, November, December, January. For 4 months, 5,000 into 4 plus 40%. He is computed only 60% of his pension. So 40% of the 5,000. For the rest, February and March, we are doing it for the financial year 24-25. So take the rest 2 months. The uncommuted pension 24,000 will be taxable. The commuted pension received 3 lakhs will be exempt under section 10(a), and the taxable pension will be 24,000. Now, what if he is a private sector employee and he is receiving gratuity also? He has received gratuity also at the time of retirement. So uncommuted pension received, so same 24,000 will be taxable for all employees. Commuted pension received is 3 lakh less exempt. What is exempt? He is receiving gratuity also. So 1/3 of 3 lakh is for 60%. So what will be 100%? We have to reverse calculate. 3 lakh by 60% into 100%, we will get 1,66,000. So this is what is given here. Commuted pension received divided by commutation percentage into 100. So we have to see what will be the 100%. We have to take 1/3 of that, and that will be our exemption amount. Similarly, here in the case if he is not receiving any gratuity, the commuted pension exemption will be only limited to 1/2 of the commutation pension. In such a case, 50,000 will come and 74,000 will be taxable pension. Now, there are certain pensions received which are exempt from tax. For example, Okay, now there are certain pensions which received are exempt from tax by certain people. Now, if such pension is received by employee of central or state government who has been awarded Paramveer Chakra, Mahavir Chakra, Veer Chakra, or such other gallantry award notified by CG, so such pension will be exempt under section 1018. In case of death of such individual, if the family receives, then such amount will also be exempt. Who is family, spouse, children of the individual, parents, brothers, sisters of the individuals, wholly or mainly dependent on the individual. So this exemption is available under the both tax regimes. Now there is another exemption here. Exemptions: disability pension given to disabled personnel of the armed forces who has been invalidated on account of disability attributable to aggravated by such service. Now, if there is any disability pension given to disabled personnel of armed forces, then such pension will be exempt. It is only for the disabled personnel, not for the personnel who have been retired on superannuation or otherwise. So if there is a disability pension given to disabled personnel of armed forces, such pension is exempt. Okay, so now let's start with gratuity. What is gratuity? Is a payment made by the employee in the appreciation service rendered by the employee. And will it be taxable in the hands of the employee? Let's see. If gratuity is received during service, it is fully taxable. If it is received at a time of retirement and received by the government employee, then fully exempt. And if it is received by other employee, we have to check whether other employee is covered under POCA, that is Payment of Gratuity Act, or not covered under Payment of Gratuity Act. If they are covered under Payment of Gratuity Act, then least of these three will be exempt. If they are not covered in the Payment of Gratuity Act, least of these three will be exempt. So let's see here. See, if gratuity is received in the time of retirement, if gratuity is received in the time of retirement by the other employee, and if they are covered under Payment of Gratuity Act, least of 20 lakh actual amount received, or 15 by 26 into last drawn salary into number of years of completion of service. Years of completion of service can be rounded off. If it is 7 months, more than 6 months, it will be rounded off to 1 year. Suppose 26 years 7 months, then it will be 27 years. And lower of these three will be exempt amount. What will be salary? Salary will be basic plus DA, both in terms and not in terms. In case of not covered under Payment of Gratuities Act, 20 lakh actual amount received, half of the average of last 10 months salary into number of completion years of service. Do not round off. If it is 26 years 11 months also, it will be considered 26 years only, so we should not round it off. What salary consists? Basic plus DA in terms plus turnover commission expressed as a percentage of turnover. So least of these three will be exemptions under gratuity. Let's now, in suppose 20 lakh is been the we have received gratuity from 2 or more employees. So can we get 20 lakh benefit for each employee? No, 20 lakh will be for both combined. Suppose from previous year I have got some gratuity, and another year again I worked somewhere for 5 years, again I got gratuity after the employment, after the retirement. So will I get separate 20 lakh benefit? No, only 120 lakh will be given. What gratuity is received earlier should be subtracted, exempt earlier should be subtracted from the 20 lakh limit. So important thing is here, salary here is different and salary here is different. Salary here is basic plus DA, salary here is basic plus DA in terms plus turnover commission. Let's see the sum. Ravi retired on 15th June after completing 26 years 8 months and received gratuity of 15 lakhs. His salary was basic 50,000 per month, DNS allowance 10,000 per month, 60% is retirement benefits, commission is 1% of turnover of last 12 months, bonus is 25,000. Compute the gratuity assuming he is private sector employee and covered by POGA Act. Now if he is covered by POGA Act, gratuity received statutory limit of 20 lakhs and 15 days salary based on last drawn salary. So 15 by 26 into last drawn salary is how much? Basic plus DA, both in terms and not in terms, into completed years of service, round it off, we'll get the amount. The three of which is exempt amount. Suppose if it is not covered under the POGA Act, what will happen? Gratuity received and the statutory limit, half of 10 months of average of salary preceding the month of retirement. So 50,000 is basic into 10 months. 10,000, only 60% is there in retirement benefits. So DA will take only 60% into 10 months, and 1% of turnover of whole year will be taking only for the 10 months. Divided by 10, we will get the average salary of 10 months into half into 26 years of service. So fraction should be ignored here. The least of these three will be taken as exemption amount and taxable gratuity will be computed. What if is government employee? It is fully exempt under government employee. Moving further, if apart from salaries, wages, any fee, commission, perquisites, profits in lieu are there, it will be taxable. Okay, now moving further, leave salary or leave encashment. An employee is allowed to take leave in every year, certain amount of leaves. Suppose he has not taken the leave, he has a leave credit. So that can be given to the employee as cash, or it can be lapsed, or it can be encashed by the employee, or it will be accumulated for the future. So let's see what is its taxability. Leave encashment. Suppose leave encashment is received during the period of service, it is fully taxable. Received on retirement, whether on superannuation or otherwise, by government employee it is fully exempt. By other employee means, if leave salary actually received 25 lakh is the limit, compare it with 10 month of average salary. So 10 into average salary of last 10 months preceding retirement. Average salary of 10 months from preceding the date of retirement, average salary of last 10 months. So 10 into average salary, 10 into average salary of last 10 months. 10 months salary on basis of average salary of last 10 months preceding retirement. So average salary of 10 months divided by 10 into 10. And the next is cash equivalent to unavailed leave based on last 10 months average salary, which is cash equivalent to unavailed leave. Unavailed leave into average salary of 10 months divided by 10. We will be able to understand this when we do the sum. So in a particular year, the leave entitlement cannot exceed 30 days. Okay. Now let us take the sum. Mr. Gupta retired on 1st December 2024. That is, from 1st April to 1st December he has worked for the financial year 24-25. After completing 20 years of service, received leave salary of 5 lakh. Other details are basic salary is 5,000. And what will be taken for the purpose of salary? Salary will mean basic, DA if provided in terms of employment for retirement benefits, and commission fixed as percentage of turnover. So your DA only 60% will be taken for purpose of salary, of leave encashment, commission, bonus is not given as fixed percentage. Leave availed during the service is 480. Leave entitled is 30 days leave every year. Now what if he is a government employee? Entire thing will be exempt. What if he is a non-government employee? Leave salary he received is 5 lakh. What is exempt is either of 5 lakh or 25 lakh or 10 months salary based on average salary of last 10 months. So 10 into salary of last 10 months divided by 10. Now here the 5,000 was with effect from 1st April, 1,000 was increased. So from 1st April to 1st December it's only 8 months. We have to take the average salary of last 10 months. So for 2 months we should take 4,000 rupees. So 5,000 into 8 plus 4,000 into 2 plus DA in terms is only 60%. So into 10 divided by 10. So this is average salary of last 10 months into 10. 10 months average salary of last 10 months will be taken as 66,000. And your cash equivalent of leave standing at the credit of the employee. So what is the leave credit? Leave allowed minus leave taken. What is leave allowed? 30 days per year into 20 years. See, it's given here 30 days per year, and how much he has completed? 20 years of service into 20 years minus leave taken is 480 days. 120 days. We have to convert this 120 days into months. 120 days divided by 30 into 10 months of average salary. What is 10 months of average salary? We got 10 months of average salary here. For 10 months is 66 divided by 10. So we will get 26,400. What is the least of these three? 26,400 will be given as least of these four is 26,400 given as exemption for leave salary. And next we shall see Provident Fund. Now in the Provident Fund, what all do we have? Employees contribution, interest on employees contribution, employee contribution and interest on employees contribution. So what are all tax treatment of all these? Okay. Now what are all types of Provident Funds? Recognized Provident Fund, unrecognized Provident Fund, statutory Provident Fund and public Provident Fund. What is recognized? Recognized by Commission of Income Tax for the purpose of income tax. What is unrecognized? Not recognized by the Commission of Income Tax. What is statutory Provident Fund? It applies to the employees of government, railway, semi-government institution, local bodies, university and all recognized educational institutions. What is PPF? PPF is for general individuals, self-employed people like who are not salaried employee, and salaried employee can also, if they wish, they can invest in PPF. So these are 4 types of Provident Fund. So what happens to the employees contribution in these 4 types of Provident Fund? Employees contribution, interest on employees contribution, on interest on employees contribution. And what will happen if the amount is withdrawn at the time of retirement? First we shall see statutory Provident Fund. What will happen? Employees contribution is fully exempt. Employees contribution is also exempt. Further, it is eligible for ATC deduction if it is opting for old regime, that is option out, shifting out of the new regime. What is interest on employees contribution? Fully exempt. Interest on employees contribution is also exempt provided if the contribution is up to 2,50,000 in previous year. If the contribution is not exceeding 2,50,000 in any previous year in that fund on or after 1st April 2021. If the contribution is exceeding 2,50,000 in a previous year after 1st April 2021, then interest on such contribution will be taxable. What will be the amount withdrawn on the retirement? Will be exempt under section 1011. Now this 2,50,000 limit will be increased to 5 lakh limit if such 2,50,000, if the employee is not receiving any employer contribution, then a increased limit of 5 lakh will be given, and interest accrued in any previous year after 1st April 2021 to that limit will be exempt. Now we shall see RPF. Contribution in excess of 12% of salary is taxable. So up to 12% of salary will be exempt. Employer's contribution is exempt. Further, it is eligible for deduction under section 80C if it opts for old regime. Interest credited. Amount in excess of 9.5% is taxable. Per annum is taxable. Amount for employer's contribution also, and interest for employees' contribution also in excess of 9.5% will be taxable. What is the amount withdrawn at the retirement? In case of recognized provident fund, it is exempt subject to certain conditions. Now we'll see what are the certain conditions. Suppose the employee has rendered 5 years of service, then it is exempt. If he has not rendered 5 years of service, then if he is not able to render 5 years of service due to his ill health, discontinuance of employee's business itself is closed before 5 years, or any other cause beyond the control of the employee, if these are the reasons, then also it is exempt. If no, then he has told the employer to transfer his account to the new employer. In such a case also, such amount is exempt. Or he has told his employer to transfer his account to his NPS account. In such case also it will be exempt. If neither of these option is exercised, these or them, he has not continued 5 years of business due to this reason as well, then it will be taxable. Okay, let's see once again. What happens is, has he completed 5 years of service? Yes, exempt. No, he has not completed because of his ill health, employer's business is shut off, or any reason beyond the control of employees, then also it is exempt. Or he has told the new employer to transfer, he has told the old employer to transfer the credit to the new employer account, new RPF maintained with the new employer, then also it is exempt. Or he has told the entire bank standing credit of employee to transfer to his NPS account notified by the CG. If it is transferred to the NPS account, then also it is exempt. If all these are not the case, then it will be taxable. So this we have done. So what is the case in RPF? 12% of employer contribution. Employee's contribution is claimed as deduction. For interest for both is 9.5%. What will happen in the case of retirement, amount withdrawn on retirement? We have to check whether he has completed 5 years of service or not. If not, whether ill health, employer's business is shut down, or he has told the old employer to transfer to new employer's RPF account, or ATCCD, National Pension Scheme, it is transferred. No. If these are not the case, then it will be taxable. Unrecognized provident fund. What will happen in case of unrecognized provident? Employees contribution not taxable, employees contribution not eligible for deduction, interest not taxable, interest not taxable. Now what will happen in case of withdrawn? Employees contribution is not taxable because it's employees own money. Interest on employees contribution is taxable under IFOS. Employees contribution and interest is salary. So employer, whatever he gives will be salary. Interest on employee contribution will be income from other sources. Now let's check what is PPF. Employees contribution is not applicable. Employees contribution applicable for ATC, eligible for ATC if opted for old regime. Interest on employees contribution not applicable. Interest on employee contribution exempt. Amount withdrawn fully exempt. See, now we'll see this question. Mr. A retires from the service on 31st December after 25 years of service. Following are his particulars of income investments. Basic pay, dearness allowance 50% forms part, 8,000 per month for 9 months. Lump sum payment received from URPF, deposits in PPF account 40,000. Out of amount received from URPF, the employer's contribution was 2,20,000, interest is 50, employee contribution 2,70,000 and interest is 60. What is taxable portion of amount received in unrecognized provident fund in the hands of the MSRA assessment year 25-26? Now, in case of unrecognized provident fund, what will happen is interest on his own employee contribution will come under IFOS, and employer contribution and interest on employer contribution will come under the head salary. So employer's share in URPF, which is 2,20,000, will be salary. Interest on employer share will be salary. Amount taxable under IFOS will be interest on employee share 60,000. Because it is contributed to URPF, it will not be eligible for any ATC. Now, will your answer be different if it was a recognized provident fund? Any amount received, withdrawn at the time of retirement, if he has completed 5 years of service, will be exempt since it's a fund is recognized when and maturity is taking place after service of 25 years. The entire amount will be fully exempt from tax. Okay, this is another sum where we have to compute the income from salary. Basic salary, DA, commission, turnover, bonus, gratuity, own contribution to RPF, employee contribution to RPF, interest accrued in RPF is given. So let's compute. Basic is, we have to compute 10,000 into 12, DNS allowance 8,000 into 12, commission on turnover will be taxable, bonus is taxable, gratuity received at the time of service is taxable, employee's contribution to RPF. Employee's contribution to RPF is how much? 20% of basic salary. So 20% of his basic salary is 20% of this will be 24,000. How much is exempt? So in case of our recognized provident fund, up to 12% of salary will be exempt. So let's calculate 12% of salary, 12% of basic plus DA in terms plus commission based on turnover 1,20,000 plus 50% of DA in terms plus turnover commission 0.5 what is turnover commission? 0.1% of 50 lakhs. So we'll get 12% to 20,760 will be exempt. Interest accrued in RPF at the rate of 13%. Interest accrued is exempt only to the extent of 9.5%. So this will be exempt, less will be taxable. Now, contribution made by CG or any other employer to account of employee under a pension scheme referred under section 80 CCD. If the contribution is made by the employer, deduction under section 80 CCD2 will be given irrespective of his old tax regime or new tax regime. If employee's contribution under 80 CCD is given, then deduction will be available only in the case of old tax regime. A deduction and such employer contribution is taxable, being employees' contribution to MPS account would form part of salary of employees under section 17(1). However, they can get the deduction. Suppose there is an central government contribution to Agnivesh Corpus Fund account. Will it form part of salary? Yes, it forms part of the salary of the employee. Such central government contribution shall be exempt under section 80 CCH2 in respect of both the schemes, but employees' contribution to such scheme will only be exempt if it has opted for old tax regime.